Welcome to Module 8 of the Capital Gains architecture. We've mapped the concepts, classified the assets, triggered the charge, and run the computations. Now we determine the tax rate. Let's look at a live advisory scenario, Project Apex. The deal team has successfully classified the asset, proven the transfer, located the charge, and run the core computation. But the final line on the memo, Gate 5, remains blank. That raw computed capital gain number is incomplete. It doesn't become a finalized tax liability until we apply the specific statutory rate route. To finalize this memo, the tax team must resolve three variables. They need to navigate the statutory rate matrix, enforce the specific domestic surcharge caps, and, if applicable, assess international treaty overrides. Selecting the correct rate route is the final step in the computation sequence. It's how the team converts a theoretical gain into a specific tax outcome for the client. We start by mapping the asset class and gain character to the correct provision in the ITA 2025 matrix. Capital gains do not use one standard tax rate. First, short-term capital gains falling under Section 196 are subject to a 20% rate. Next, general long-term capital gains under Section 197 trigger a 12.5% rate. Note the specific rule for Section 197. This 12.5% rate is generally applied without the benefit of indexation. Then we have eligible listed equity and equity-oriented funds under Section 198. These also receive the 12.5% rate. However, the Section 198 rate only applies to the portion of gains that exceeds the 1,25,000 rupee threshold. Finally, virtual digital assets are excluded from this matrix. They face a 30% rate under a separate tax regime. Applying an incorrect section from this matrix results in a flawed base tax calculation, which creates professional risk for the advisory team. Establishing the base rate is only the first step. To reach the actual liability, we have to adjust that number using domestic multipliers. The Finance Act 2026 introduced a statutory limitation here. For capital gains under Sections 196, 197, and 198, the surcharge on the income tax is capped at 15%. The law requires a specific sequence. Health and education cess must only be computed after the capped 15% surcharge has been added to the base tax. Correctly enforcing this 15% cap is a mechanical requirement that protects the client from overtaxation on large transaction values. For our non-resident seller, domestic law alone isn't enough. The sequence is strict. Establish domestic chargeability first, then look to Sections 159 and 160 for treaty relief. This relief requires three documents: a tax residency certificate, proof of beneficial ownership, and limitation of benefit conditions. Confirming these three variables, the matrix, the cap, and the treaty, allows the team to formally finalize the advisory memo. A complete advisory memo requires this layering effect, applying global treaty benefits only after the domestic tax base has been accurately established. Here are your capabilities. Navigate the full capital gains rate matrix based on asset and gain character. Apply the surcharge cap and cess to reach the effective tax outcome. And identify when non-resident rules and treaty overlays must be triggered. Let's finalize the calculation. Begin the module interactions to master the rate route.